Are you sitting on lazy equity that is holding you back? Maybe, and we're going to talk about that on the Furlough Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission is to equip people to invest wisely in both property and residence so that together we can build wealth while improving housing. I'm James, and this is my wife, Jessie.
Hey.
Hey.
I am appalled.
Whoa, don't step on my feet. What are you doing?
Sorry about that.
Come on.
I'm appalled by
I'm sorry to
how
hear that.
much garbage can accumulate in our children's rooms.
Oh.
Like, when
Yeah.
they clean, I'm just like, where did this come from? How are there two garbage bags full of stuff that we're getting rid of?
Yeah.
It's just like, I mean, it's not so surprising because
be
you
fair,
walk in and it's
they're not the ones buying the stuff. Just to
okay.
put it out
That
there.
yes, that is part of the problem.
Yeah,
is,
yeah. And it's not me
their
buying all this stuff. I know
mom
that.
gets them a bunch of junk, and I let them create
Mm,
mountains of art projects. And
yeah.
okay, that is true because the other day, Eleanor was doing a school project. She needed some boxes to kind of craft this project.
Yeah, I
And
remember
so I collected some boxes, and our son, of course, was like, "Hey, Mom, what are these boxes for?"
Oh, man.
I was like, "They're for your sister for her project." And he was
Yep.
like, "Okay, well, can I have the extras?"
And what did you say?
I said yes. Why do I say these things?
Yeah, see, this is
Oh,
on
yeah.
you. It's
It's-
on you.
Okay.
Why are you trying to point fingers at the kids?
Partially it's on me, but
Man, you're an
it
enabler.
is surprising how much
man.
stuff comes out of those rooms.
Yeah.
I mean, I
that's-
surprise myself too when I clean out areas that are mine. And
Yeah.
I'm like, what is all this stuff? Where did it come from? Why?
Totally.
Why do we have this?
Well, I had a surprise a few years back because I was taking inventory, looking at our investment portfolio, and was just like, man, I haven't really dove deep into them recently. I should look at them.
Yeah.
And I decided to do some math that I had never done before.
Mm-hmm.
And essentially, normally when you're doing the math of something, you look at your ROI, your return on investment.
Right.
So how much money did you put in? And then you take your annual amount that you're getting for it, divide it by that, and you get your number.
Yeah.
And, yay.
Year over year, how much you're getting?
Yeah, all that fun stuff. And they look great. Like for example, we had a duplex that we did not put very much money into at all. I mean, it was like a few $1,000s for the down payment, and every single year it was throwing off a bunch of cash. And our return on investment was like 52% a year.
Which is quite good.
Yes, fantastic.
Yeah.
But then what I started doing, because at the time the real estate prices had started to rise a lot, I wonder if I do this by the amount of equity that I'm sitting in here. Essentially looking at the opportunity cost. If I had taken this equity and put it somewhere else, what kind of return, like if I just put it in the stock market, what kind of return would I be getting? And so that's not a fair comparison because you got to pay capital gains tax and all that stuff. But, just in theory, right? If I put it into another deal.
Sure.
And that had risen so much that my return on equity was single digits. It was tiny. It was like, I can't remember the exact. It was like 6% or something.
Can
like
you
that.
run me through like a simple
Yeah.
example?
Okay. Let's say you've got a property that's doing $1,000 a year.
Like
Okay.
making $1,000
Making
a year?
$1,000. That's the cash flow.
Okay.
Okay. Just trying to keep this really simple.
Yes.
And let's say that you invested $10,000
Okay.
into this property.
Okay.
Okay. Do you know what your return on income on
Return
investment
on
is?
investment?
Yeah.
Well, it would be that.
It's 1,000
1,000
divided by 10,000,
Uh-huh.
which is 10%.
10%.
There
That's
you go.
easy math.
Okay. I'm trying to help you
I
out
just
here.
didn't want to make an obvious
Yeah, no,
mistake.
you're good. So there's there's
10%
that.
is- yep.
But let's say you bought it, you put in that $10,000, yay. Over time, the equity has increased, and let's just say that it's risen by $40,000.
Oh,
So now your equity in it is actually
50,000.
exactly. So now if you have that $1,000 divided by 50,000,
Oh,
do you know what your return on investment is on that one?
5%.
No.
0.5%.
See, 5% would be
Oh my gosh.
20,000.
Can't do
That's like
this
2%.
math. Okay.
So all of a sudden you went from like, hey, a respectable 10%, I feel good about this, to a 2% where you go, oh my gosh, this is not good.
Yeah.
And we were having the exact same situation.
Huh.
Because part of it was we didn't invest very much, and the amount had risen a lot.
Yeah.
And so I suddenly was like, oh, shoot, I need to do this for my other properties as well. And it became very quickly, to me, became very obvious very quickly. I'm like, oh my gosh, I have 3 places that I need to sell. It's borderline irresponsible for me to hold on to these because of that opportunity cost of what I could be doing with all the equity that was trapped in. That was the lazy equity.
Interesting.
Yes.
Okay.
And so I think investors run into this problem where you buy a property and you go, awesome, cool, long-term investment, we're good. And you just kind of like, you just collect the cash flow, especially if you have a property manager. You just kind of like, whatever, you know, things
It's
are
just
great.
there, yeah.
I'm not going to worry about
Doing
it.
its thing.
And I think that we can do better. And especially right now, at least in Oregon, it's spring break. And so you may be having spring cleaning on the mind. And so I think it's good to do that with your investment portfolio. And so I've got some ways, some tips, some thoughts on how to go about doing it. Now, the math that I just did, I think is like, you should
that's
do that.
One way.
You should definitely
do the math on your properties.
Worth looking at. If anything, just kind of like, you should look at the overall, like actually I wrote a note here, do a financial deep dive, right? So you should look at the cash flow and compare that, not just like, how much am I making? And what is my return on investment? What has my average annual return been? What is that return on equity? There's probably a more official term for it, but that feels right to me. Now you might be saying like, well, how do I know what my equity is? Like, dude, I don't know. Hop on a Zillow and just see what it thinks the value is. It's okay. Yeah. And it may make sense to jump. That's actually in the syndication world. That's kind of a rule is you buy a place that's a value add deal. You go and you fix it up. And it's like the day you finish it, the value add, you actually want to sell it. That's like the perfect timing. You just can't. And because it just doesn't, it's like, it's just really hard to do.
It rarely times out that
same
well.
with flips, by the way, right? Like that's one where it's like, there's a ton of value. And then you create so much equity so fast that you're like, I should cash this in almost immediately. For every additional day I hold on to it, my average annual return just goes down. And so that's usually like, that's the game plan. That's why syndications and bigger people, like they just don't hold on to them for very long because like our returns just go down over time. It's not worth it.
Interesting.
So anyways, do that cash flow analysis. Again, it doesn't have to be crazy. You can do the simple math that I did that was like, oh, this is an eye-opener for me. Other things that you want to do is you want to review your debt and financing that you have on it. Do you potentially have an opportunity to refinance? And that was an option that we had with our properties. We could have said, I want to unlock this equity by just getting bigger loans. Yes, my cash flow is going to go down, so be it. But if I take that money and I roll it into another investment, that'll more than make up for the cash flow.
Right. Well, especially if you can lock in a good interest rate on a refinance.
And that's another thing, right? Again, you kind of like, you get the interest rate and you just kind of, whatever, it is what it is.
Sure.
Even though right now rates are like 7.5%.
Right.
But still, right? Like it's fine.
Yeah.
And so it's worth doing that regular review, just saying like, where am I at on my debt? It also makes sense, like this time of year, we're not quite in tax season, but we're getting pretty darn close to it. And so just from a tax standpoint, it makes sense to like, is what I'm doing make sense for my taxes? And again, like a 1031, which is ultimately what I ended up doing with those 3 properties, rolled them into something bigger. Does that make sense to at least get that equity? Like the equity doesn't go away, but can it become a much smaller proportion relative to the cash flow I can get from another place? Essentially reset that. Essentially reset what, that ratio. Yeah. And
are those two like refinancing or doing a 1031 exchange? Would you say that either of those have equivalent returns, or is one better than the other, or does it just really depend on the properties? Because to me, it seems like a refinance is easier in some ways. Like you just talk to a bank and get a new loan, as opposed to, okay, if I'm going to like do a 1031 exchange or sell this and buy something else, I have to find another property. I've got to evaluate, what that's all about. Is it going to work? I got to get my timing right for selling these and buying that. And it seems a little more complicated, but maybe it has a lot better returns. I don't know.
Yeah, that's a great question. I think it depends, obviously. So when you sell, you're going to pay like
Yeah, capital
realtor fee.
gains.
No.
Oh.
Even if you're doing a 1031, right? You got agents involved.
Okay. Yeah.
And so the properties that you're selling, you're going to have a fee. Now, I ended up listing them on my own,
Okay.
and so I didn't have to pay that.
Mhm.
Well, that's not true. From one of them, there was a broker involved,
Mhm.
and I had to pay 3% to that broker. The other two, we didn't have one involved, and I didn't have to.
Mhm.
But in general, like, so there's a loss there that when you refinance, you don't get that.
Yeah.
And there are obviously some funding, some debt fees that go with it, but that happens no matter what.
Sure.
I think it's a question of you saying, like, if you were to, so at the time when we were looking at it, just because of where the market was at and what was going on, I was, and I could have talked to other brokers, I suppose, but at the time they were like, they were not going to give me a very high loan to value ratio. Okay. And so I wasn't going to be able to pull very much money out of those three properties. And so it was going to keep me in that small deal territory, right? So it was something like I was sitting on, it was kind of crazy. For all of them, it was $200,000 worth of equity, which is part of my like, oh my gosh, like all of a sudden this return I'm getting is not great. But had I refinanced, I would have only been able to access like not even half of that for each of them. Yeah. And so, and it was just because of where we were in the time and whatever. It was super weird. And so it was one of those where I was like, yeah, 300 grand's good. But it was still going to, and it was going to still keep me in like that, like wherever I went, I still was not going to have do a lot down. Yeah. It just kept me in a small deal territory. But by selling them and getting something, it allowed me with the 600,000, I was able to jump up to a much bigger asset. Yeah. And even a totally different asset class and all that stuff. And so at least for the opportunities that were sitting in front of me, it made sense to say, yep, I'm going to sell them. I could have done a combination. I could have 1031'd and I could have refinanced and then put all that towards something, and that could have been.
So it does depend, but
yeah. And I think,
are those the two? Are those the only two ways to use your lazy equity? I don't know how to say that.
Yeah, essentially, yeah. Refinance or sell and or then roll that into something else. Yeah. Yeah, okay. That's pretty much it, which I like, because we ended up rolling it, right? I didn't technically unlock it. I moved it somewhere else,
and made it more value. You leveraged it.
Yeah.
In a better way.
Also worth considering is, so like this could have been an interesting strategy. I could have sold two of the places, get the 400,000, invest that into something, and then I could have refinanced another one and maybe take like 50, 60,000 and use that as a rehab budget to then fix the place up, get the value add, and then in theory, once I did that, if I add enough value, I could refinance that big project one more time at this new value and get a bunch of those funds back in the form of debt. And yes, I get it. My payments and everything would go up, but I could then use that money to go kind of keep rolling, keep going, potentially.
Yeah, you could get creative with it.
Yeah.
Depends.
Because that's the problem with the 1031 as well, especially if you're doing value add deals, is it all has to be used for the down payment. Right. Okay, it's not technically true. I know if you guys are out there, like you can use it, but there's very tight timelines for how long you have to do the rehab and spend the money. Yeah. And so it's just, don't think of it that way. Hard. Just think 100% for the down payment. And so, yeah, it's tricky, but those are the primary ways in which you can unlock the funds. Other things you want to look at is just the property performance, right? Just kind of check in, is this performing the way that I thought it would? Sure. And I'm thinking things like talking about like just vacancy rates, how often are turnovers happening? Is that what I thought it would be? It's always fun to go back and look at my like original underwriting and be like, how did I say this was going to happen? You want to take a look at the maintenance and plan out any bigger capital expenses that you might have coming up. Yeah. Right. You may not spend it, but at least you're going to plan it because good weather's coming. So you want to, it's a great time to do it. And just in general too, you want to ask the question, right? Does this property still make sense for what I'm doing? Like I know sometimes we pick up stuff just because someone had an investment and they moved to a whole another state. They're like, man, this doesn't make sense for me anymore. I want out. Or whatever reasons it might be.
Yeah, whatever it is.
They're like, hey, I've really specialized in this different type of asset, and I'm just not even messing with this anymore. It just doesn't fit with my system, so I want out.
Or there's all sorts of different reasons.
Yeah,
why you may need to adjust the properties that you're invested in, like you're aging and you used to do all your maintenance, and now you can't do that anymore. So you're gonna put it into something different.
Yeah. Physically, maybe you just can't manage everything on your own anymore, and so you need to change the type and switch over to the passive side of things, or hire a property manager, or whatever.
Yeah.
But all right,
keeping tabs on that, paying attention to it.
Yeah,
that's
totally right.
Yeah.
We already kind of talked about this one, but just asking that question of, does it make sense to keep, sell, or refinance? Some of them just kind of based on what it is that you're learning, and then what are my notes here? And then you just want to. Oh, I remember. So those are the big things that you really want to do, right? Just you want to look at, again, like, how's it doing financially, how's it doing operationally, and then how's it doing just within the context of my bigger portfolio, my bigger goals. Like, those are kind of the three main areas that you just want to look at for each of them. And what's nice about this is, honestly, this is what the big guys do. They don't just set it and forget it.
Yeah,
I think. And I think in one of his books, I think it's Cash Flow Quadrant, Robert Kiyosaki talks about the 5 levels of investors. And he talks about one of the levels, I think it's like a level 3, whatever, where he's like, yeah, this is the set it and forget it. It's the folks who they put their money into a 401k and they go, whatever, someone else is dealing with it. And which I totally get, and I think people can get that way with their properties as well. We're like, yep, I got it. We got tenants. I got a manager.
Yeah,
I'm just not going to worry about it. Like, yeah, I get it. And you don't have to look at it that hard, but at least annually,
you should, keep tabs on it.
It's worth looking at. Yeah, and I think it's just good. It's just a good habit to be like, yeah, here's, this is like, it's a meaningful part of your wealth. And so
do you have any good either like systems or resources or tricks for like how to keep tabs easily? Like tracking systems, or, do you just like open up a spreadsheet and write stuff down every single month, or, you know what I mean?
Yeah.
Like, how do you easily
So this
track
time of
that
year,
stuff?
especially, I think if you haven't submitted your taxes, in order to, which I haven't, because we wait till the end because of other stuff. I got a bunch of K1s that I was going to wait for, and it just takes forever. But in theory, if you're preparing your taxes, part of what you're doing for any rental that you own, you got to hand over a P&L to your accountant. And so that is like a perfect time to start to do it, because you're going to get, here is all my income, here are all my expenses. And it's just you can ignore depreciation for now if you want to. But just get that net operating income, your cash flow essentially. And you go, cool, there's that number. You've already done, either you or a property manager has already done the work to figure that out. Now it's like, just get a couple more numbers. Number one, how much did you invest in this property?
Yeah.
Divide that, do a little comparison, and try to do your best guesstimate on what you think the equity is. Again, it's going to Zillow, looking up the value, subtracting out your mortgage principal, and then divide that from the cash flow for the year. Just be like, yeah, where was I at on this thing? I think spreadsheet, the best app in the world, Excel. Yeah. It doesn't have to be super complicated to get some of those ratios. And then you can, if you really want to, you can look at them over multiple years to see kind of how, like, is this a weird year? Are you on track?
Yeah,
is it slowly getting better?
Yeah, get
is
rid
it
of the
slowly getting worse?
outlying.
Which my guess is the return on investment is slowly getting better over time, and the return on equity is slowly getting worse over time.
That would make
That's
sense.
my guess.
Your lazy
There's
equity
a nice
is building.
There's a nice little thing there. I think for the vacancy and turnover, I think it's just worth if you're not, if you got a property manager, you can ask, but you yourself should be like, yeah, how many vacancy days did I actually have? And going through and looking at that. Yeah. Ours are super low just in general in this area. And so that's usually not a factor for us.
Because no one wants to move when it's raining.
I know,
and it's always raining.
I know. It's kind of nice. For the maintenance and capital expense piece of it, I think it's good just to do a walkthrough. Again, either you or property manager just like, hey, how are things going? Sure. And then for the CapEx piece, an app that's not free, but I really like, is called Estimate On, and you can download it, and it's made by Verisk, and you can go in and just like, hey, I'm thinking about doing the roof. Like, I'm just trying to get an idea for what the cost would be.
Okay.
And I think they might give you a couple free rounds before you have to start paying.
Okay.
And I blow through this really quick. I think you get like 3 free a month or something. And you can, it's 3 free projects, and you can have as many like line items as you want. Like you can do roof, paint, new carpet, new flooring, windows. Like you can have.
That's a project.
No, that's within it. Yeah, those are all bundled together is a project. And so pick a property address that represents most of them, and then you can do all the numbers for all of them if you want, and you have just a singular project.
All right.
I guess. Yeah. So that's like a tool that you can use, or honestly, you can also like if you're thinking about doing a roof, just be like, yeah, let me just make some phone calls and ask. I think is the way.
Yeah, that seems to be like what would make the most sense is keeping tabs on things a little bit at a time. I don't know what that principle is. Somehow, or at some point, we talked about. You talked about it in like cleaning or like doing laundry, and it's like 5 minutes a day, like just a little bit.
Yeah,
like
tortoise in the hair.
You never get you never get behind. It's never this big deal.
Yeah.
That no, now I have to evaluate my property and where am I at?
Yeah.
It's like okay, I'm going to create this spreadsheet.
Yeah.
And when I'm thinking about the roof, I'm going to put some information in there, and a little at a time.
Yeah. Yeah, I think it's also important to do just even as a passive investor. Obviously, it's a lot simpler, but it's good to look at like, hey, what's my return look like? And maybe it makes sense to, honestly, call up your sponsor and be like, hey, man, how's it going? Like, tell me about this project. If you haven't heard from them recently on what they're doing, I think it's a good thing to do.
Well, and I think either sponsors or property managers should be giving you regular reports, and if they're not,
totally,
you totally can ask.
Yeah.
How are things? Give me some numbers here. Like,
exactly.
Where are we at?
Yeah. Totally okay and expected to do that. So there you go. That's happy spring cleaning. My hope is that you listen to this and go, yeah, I want to find out what my numbers are and grab them and look them up and do some of the ratio stuff. And if you do have any trouble doing that, I love looking at this kind of stuff. So feel free to reach out to me and it's just fun. So I'm totally happy to look at whatever it is and to go through it.
It's true. He loves spreadsheets.
I do love a good old spreadsheet.
He loves some good math.
I do. And again, even if you're doing it passively, I think there's some interesting things to look at and say, does this still fit with what I'm doing? So there you are, man. Happy spring break to do some spring cleaning. Let's get after it. It'll be great. So with that, stop listening to us. Get outside. Well, hopefully, maybe you're walking around listening. That'd be cool. Or if you want to, you can also just hop online. You can check us out at furlough.com. Learn more about us, our investing thesis, how we think about things, because we are regularly looking at and reevaluating our portfolio. And I feel like there was something else. And honestly, if you love this podcast, we would love to know that. Feel free to leave a comment wherever it is that you listen to them. And so thanks for listening. Have a great day.